Hello, chart watchers, and welcome to this Wednesday, August 28th, 2019 Market Watchers live show with your host, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Taking a look at the market action, we opened lower today, but rebounding, the opposite of what we saw yesterday. Currently, Dow Jones Industrial Average up 184 points, once again challenging this 20-day moving average. The S&P 500 up 15, the NASDAQ up 29, and the Russell 2000, which actually had broken to a new closing low yesterday when we look back the last few months. It is up 20 points today, so it is having a very nice day on a relative basis. Haven't seen that in a while. That's nice. 10-year Treasury yield continues to drift lower, though. We are now down to 1.46%, down another 3 basis points today. Not good action there. Volatility index continues to remain high. So with a big move today to the upside in the Dow, there's still a lot of fear out there. The VIX still up 19.68. It is down 3% today. It was up closer to 21.5 earlier today, though. Energy having a pretty strong day to the upside, along with industrials and consumer discretionary. All of these up over 1%. And then you've got utilities lagging currently today, the defensive group, with more money rotating into more aggressive areas today. You can see utilities suffering a bit, but this has clearly been one of the better areas in August. Apparel retailers, we never know from day to day what's going to happen. Today it's up. You look back over the last 3 to 4 weeks of action, and this is one group that is all over the place. It moves a lot with any kind of trade news. But today the action is positive. Really needs to get up above about that 905, 910 area to really begin to make technical headway. Footwear also consolidating here over the last 3 to 4 weeks, but having a strong day today. And then the oil group. I mean, if we look at oil equipment and services, haven't talked too much positive about this group in quite some time, but it is having a nice day today, up a couple percent. In the Dow Holdings leading the Dow Jones higher today. And one company reporting dismal earnings results. Actually, the results weren't bad. It was the guidance. But Autodesk, you can see, down quite a bit today. It is the worst performer on the S&P 500. All right, Erin, it is Wednesday. It's hump day. Happy hump day.
Well, thank you. I don't get usually wished that in the mornings or at any time, actually.
It's one of my favorite commercials of all time.
I do love it, too. I really do. But we can't say who it was, right? So that we don't want to give them promotional time.
I don't care. I walked into Starbucks. I'm going to give them some promotional time right now.
There you go.
I walked into Starbucks this morning, and one of the guys I know from Starbucks, because I go in there every day to write, and his name's Mike. And he's sitting in my seat, and of course, I knew it was Wednesday. So I walk in, and I was like, Mike. Remember the commercial, of course. But anyway, we'll move on. We got a great guest with us today, Jesse Felder. Jesse, welcome back to Market Watchers Live.
Hey, thanks for having me back on, guys. I guess I didn't embarrass myself too much last time I was on. So thanks.
No, you're good. You're good. I'm counting on you to have all the answers for this crazy market we have in August. You got all the answers for us?
Well, I'm going to try. I have a lot of confidence, but that can change at a moment's notice. So,
all right. Well, I know you got a presentation prepared for everybody. Everybody's on the edge of their seats waiting to see what you have to say with everything that's been taking place. So if you can stick around with us, we'll get back to you probably in about 10 minutes or so. All right, Erin, what do we got?
All right, upcoming schedule. Tomorrow, you're going to be doing a seasonality report for everyone. See what's coming up in September. We are not going to be here September 1st. That is Labor Day, and the market is closed. And Wednesday of next week, we will have Linda Raschke on the show. Can't wait to talk to her. Today, though, Jesse Felder is on the show from the Felder Report, and 10 in 10, we will do Anaplan. PLAN for the first 10 in 10 symbol. Go ahead and get your requests in the chat room and vote for your favorite, because that will be the second symbol we look at. All right, technical news and headlines.
All right. Well, there was no economic news out there of any significance today. So I'm going to just jump right into the 10-year Treasury yield, which is where I like to start, because it does have an impact on a lot of different areas of the equity market. And you can see today, right now, the 10-year Treasury yield is down 2.6 basis points. So we're down to 1.46%. The steady downtrend continues. Yesterday, we closed the lowest level we've seen in 3 years, and we're getting really close. If we pull up the longer term, actually, I'll just leave the daily up here, but let's go back the last 5 years. you'll see that we're starting to get very, very close to those lows that we established back in 2016. We're at 1.46%. Now, I think that low was like 1.34%. So not a whole lot of room to the downside. That would be a very significant technical breakdown if we move back below that 2016 low. There's a lot of arguments why it's happening, but I can tell you that this is a lot of money that has rotated into treasuries over the course of the last 10 months, 9-10 months. And that every dollar goes into the treasury market, can't go into the equity market. You got a choice to make how you want to invest your dollars. Normally, the best market moves are made when the 10-year treasury yield is rising, because that is an indication that you got money rotating out of treasuries and into equities. All right, earnings reports. Still got some reports coming out, a couple overnight. And then you can see after the bell, we've got a few more coming out. But this morning, Brown-Forman reported. Tiffany and Company also reported and beat. Cody matched estimates. I don't have last night's, but a big one that I mentioned at the opening of the show, Autodesk, really a bad one. And I talked about Autodesk a little bit during the Monday earnings spotlight segment. Listen in. Autodesk also trading down, and we're talking about the software group. Look at this move down, the volume increase, hardly any bounce whatsoever. I think we got a bear flag. Maybe you could look at it as a symmetrical triangle, pennant. I don't know, whatever you want to look at. It doesn't look good to me. Downtrend versus the software group, and the software group's been strong. So if I'm going to own a software stock, it's not going to be Autodesk. I don't know what's coming out of their earnings report, but I would not trust this one at all. All right, welcome back. The whole idea of that segment on Monday was just simply to take a look at how stocks trade ahead of their earnings reports and to maybe make an educated decision on whether or not you want to hold a stock into its earnings report. Anytime I look at a stock like Autodesk, which number one, it's in one of the best areas of the market. Software has been a leader for a few years. It continues to outperform the S&P 500. And there are a lot of software stocks that have been performing really well. But in this environment, you can see Autodesk was underperforming and had been for several months. And really, it's been a pretty steady downtrend now since the relative high back in February. And from a technical perspective, I mean, I literally could probably draw you in here a head and shoulders top that broke down. So let's take a look here. But right here, I would consider that maybe a left shoulder. Or excuse me, left side of the neckline. So left side of the neckline, right side of the neckline. Here's your left shoulder. There's your head. And there is your right shoulder. And on the breakdown, look at the volume picking up to confirm that move. We pull back. We get one little weak bounce, which I mentioned on Monday. Really not sustainable. And then the earnings come out. This is not a surprise to me at all. Autodesk did beat, believe it or not. They beat on their top and bottom line. So it wasn't that. That's not why everybody was getting out. They saw weakness ahead. Autodesk guided lower. They guided their earnings per share lower for next quarter. And then they guided both their revenues and earnings per share lower for next year. So the market was telling us something was going on, wasn't happy with Autodesk going forward. And sure enough, we got the news. We get the fundamental news after the technical breakdown. I think it's really important to keep an eye not only on what a stock is doing on its absolute chart, but take a look at what it's doing relative to its peers. Because if software is in favor and you own a software stock and it is weak, that is probably not a good sign in terms of what's likely to be coming in terms of the fundamental news. So I just wanted to point that out. I thought that you can go through, there's some other stocks I talked about on Monday. You can always go back and listen to the recording. But there are some that I think that could be very solid. We have one coming up tonight after the bell, and that is OKTA. Another software stock. Take a look at the difference here between these two stocks. So OKTA on a relative basis right here is just hit a 52-week relative high to the software group. Now, does that guarantee us that we're going to have a huge move to the upside? No, it really doesn't. What it tells me is that we're probably going to get a good report, but it's always difficult to see how the stock market is going to react. Vibha Systems, another software company, they reported last night, and look at the initial gap up, but then the sell-off. They came out with really solid news, beating estimates, and yet even after moving higher, you can see the move back to the downside. I think Vibha continues to be a really solid stock within software. And when it got down to price support, you saw folks jumping back in here. We'll see how it closes today, but at least for now, this one is holding up a little bit. All right, I did want to mention if you go into the dashboard and you happen to look over here at the scooters, you'll see TTOO. And that is going to be my focus today for the scooter. It's not Tattoo. It is T2 Biosystems. Notice the PPO's gotten up to the zero line. Here's that scooter move coming out of, just awful territory where TTOO has been down below 10 for quite some time. But, you see it on the scooter mover and you think, oh, this one's something I should be considering maybe on the long side. Well, when I looked at this chart, you have to understand how the scooter is scored. This was a huge jump in the 20-day rate of change. It's going up, but what happened was yesterday the rate of change was at 0 if you look at this. And that's because yesterday's close was right where we had closed back in 20 days prior, 20 trading days prior. But look at what happened today. The stock is actually down, but the 20-day rate of change went soaring up because now we're comparing it to where it was after the huge gap down back at the end of July. So now the rate of change is all of a sudden 140%, which has sent the scooter up. It's challenging overhead resistance. It's challenging gap resistance. I think you have to be careful with that. And for that reason, it is my scooter mover of the day.
All righty, let's go ahead and look at some upgrades and downgrades. And we're going to start off with Papa John's. Papa John's was upgraded today by Stifel from a hold to a buy. They have moved their price target from about $42, which you can see is right about here, just above the lows that we saw back here in June and September. And what I was going to show you, that's why I pre-marked up this chart, is what I saw as a head and shoulders coming in off of this rise, this price rise. And it did have a sloping neckline, but it did end up executing back here. And then you can see if you measured the height of the pattern and then you take it down from there, that brings you right about where we got the low that came in June. And once it had executed, once it hit its minimum downside target, fortunately it was near the minimum of the target, it then began this this consolidation period. And now we finally got the breakout. We got it to break out yesterday. We're seeing a continuation of that breakout to 3 3/4%. They have moved, like I said, their target, they've moved it up to $60. So we'll put that up here so you can see how that looks. That really does, it lines right up with that that 2018 top in the final quarter. And, so I would expect to see it break out right now, but I would wait for a pullback toward that breakout point because at this stage, we would be definitely chasing. All right, next one up was, let's see, TRGP. This one, Targa Resources, was upgraded today. And, it's hitting that area right here where we had that low back in December of 2018. It came down, didn't quite get there, but it does appear that it wants to rebound here. And when you look at this PMO a little more closely, you can see that we did get a fake out here on the PMO rising, and now we're seeing it once again, but it is very oversold. It's actually better, and I think, Tom, you even had come to that conclusion, is that when you get those buy signals or those moves and the bottoms above the zero line, that shows you there's some internal strength there. This tells me we still are showing a lot of internal weakness, and notice how far below the 200-day EMA, the 50-day EMA is. This has been in a downward slope for quite some time. And and they had their target set at $48. I think that's awfully optimistic at this point on that upgrade. All right, NBR Neighbors Industries was downgraded today, and they did not list a target, but they went from a buy to a neutral, so it wasn't a terrible downgrade, if you want to call it that. So they're really moving more into a neutral position, but I suspect the problem is this breakdown that we just recently got here in August. And that's all I have for the upgrades, downgrades. There weren't too many today, but there they are listed. I didn't go over all of them. All right, we'll be back with Jesse Felder right after this. All right, we are back right now with Jesse Felder. He is the founder, editor, and publisher of the Felder Report. And Jesse's been involved in money management for actually over 20 years. And he began his career at Bear Stearns and Company. But now he is doing his report, the Felder Report. Glad to have you here, Jesse. What have you got for us? The market's crazy. We need to know what to do.
Yeah, thanks. Thanks, Erin. I thought you were going to say 40 years in the markets. I'm not quite that old yet.
No,
But,
that would be a lot of experience, though, for you.
Yes. No, last time you guys had me on, I went through like my whole chart book and it covered a variety of asset classes. This time I figured I'd dial into the broad stock market a little bit more and just take a look at some of the things I'm looking at. This first chart here is just a weekly chart of the S&P 500. And for at least a year now, I've been calling this kind of a topping process. This looks to me, I think it's pretty easy to probably draw a megaphone or broadening top pattern here right now. But when I look at the other indexes, I think it helps to kind of see what's going on with the broad market aside from just the S&P 500. So we see the S&P since made this high in early 18, made another high last summer before that fourth quarter decline. And this year we've taken out those highs before giving them back, which could prove to be a false breakout. But we look at the NYSE Composite Index. We can see that since that 2018 high, we've essentially only been making lower highs. And to me, this kind of is just a sign that even while the S&P has been powering higher, the broader, under the surface has not been doing that. You also look at the Russell 2000. You can see that we did make this high in early 18. Then last summer we made a new high, but since then, we're down close to 20% on the Russell 2000. And the Dow Transportation Average too is another one. That shows, kind of not the type of strength that we'd want to see at the highs we've made this year. We see, increasing kind of dispersion among the indexes. And really, I don't know how much you guys talked about this, recently, but it's pretty clear, I think, to anybody that there's a Dow theory non-confirmation. The industrials made a new high. Transportation average is not close. And I think, that was originally intended as more of an economic signal than a technical one when it was developed. And so along with the things like the yield curve, which is much more popular for people to talk about, this is a sign of potential economic weakness. And we're seeing that about a number of other things that I'll get to. But this type of dispersion among the indexes really reminds me of the topping process in 2000. And so here are a few charts of the same indexes into that 2000 top. We see the S&P famously peaked in March of 2000 before kind of rolling over to the end of the year. Really, bear market didn't kind of kick off until 2001 when we took out these 2000 lows. But the NYSE Composite actually went on to make a higher high in September of that year, which a lot of people don't remember. Everybody thinks, the NASDAQ blew off in March of 2000. That was it, was done. No, the NYSE Composite went on to make a high later on in the year. Russell 2000 did peak in March and then rolled over pretty hard after that March, kind of similar to the NASDAQ, although it did dramatically underperform the broad markets. And we'll look at that later on too. But really the transportation average was the one that peaked in, almost a year before the rest of the market. The Dow Jones Industrial Average, I think, peaked in January of 2000, but the transports peaked in, was that May of 1999 and had rolled over really hard while the rest of the market kind of went higher. And to me, that was that potential economic warning signal, also a red flag for that growing dispersion across the indexes. And so what contributes to this growing dispersion? It ties into this economic weakness. This is something else that dates back to 2000, and Stan Druckenmiller talked about a year ago, is that he famously was trying to short the NASDAQ in March of 2000. On the day that it peaked, though, he capitulated and covered all of his shorts and went heavily long the NASDAQ right on the peak. And then the market rolled over really hard in that March peak, and he decided to sell all of his longs and try and go short again. And he actually had such a difficult time during that period. He took a hiatus from the markets because he was just not trading very well. But he came back in the fall of 2000 up here when the NYSE was making this new high, and he had noticed something, and that was that interest rates had been rising, the oil price had been rising, and the dollar had all been rising together. And typically when you get all three of these things going on like this, it typically leads to a recession, and almost always leads to an earnings recession. And so what we've seen over the last couple of years is very similar to what we saw in 2000. We had rising interest rates until very recently. We had, essentially from the election until late last year, we had rising oil prices rebounding after their sell-off. And then we had the strength in the dollar, which everybody, has been paying attention to because, Trump has been so vocal about complaining about the strength in the dollar. And so all three of these things are something that's been going on for a couple of years now. So what are we looking at now? We're looking at an earnings recession again, similar to what we saw during that 2001-2 bear market. So I think this is what markets are beginning to price in, is this type of economic weakness as a result of these macro trends. This chart, a lot of people have been talking about the yield curve. This is a chart. I've inverted the yield curve here and overlaid it with VIX. And when you look at these things, and it's really kind of hard to make sense of this chart, but when you shift the yield curve forward 2 or 3 years, you can see that the yield curve, when it flattens, it begins to forecast rising volatility. And this makes perfect sense to me in terms of how the credit cycle works. You get a flattening yield curve. Banks have no incentive, lenders have no incentive to borrow short and lend long. There's no profit margin in it. There's no net interest margin. And so you get a contraction of credit, which leads to usually a widening of spreads, usually financial stress. Financial stress is very highly correlated with the VIX. And so we should be, entering this period, the yield curve, not only forecasting some economic weakness, it's forecasting some, financial stress over the next few years, which should lead to a rising VIX. This was the case during the last 2 cycles as well. So, we're seeing these signs of, whether it's rising dollar, rising oil, rising interest rates, flattening yield curve. All these signs are kind of macro signs pointing to economic and market weakness in the future. And when you actually dial down into the sector-specific stuff, you can see this. The most cyclically sensitive sectors in the market are the ones that are diverging most dramatically from the indexes. You have, retail here. This is the relative performance of retail to the S&P 500. Transportation average, and metals and mining. You can see all these things kind of weakened through this 2015 and early 2016 period, where we had, according to some people, we could have had a recession in that early 2016. We definitely had a manufacturing industrial recession. But again, since last summer, we've had renewed weakness in these economically important sectors, and so that's really what's driving the dispersion underneath the surface. And I think it's even fun to dial down even further and look at something like the gap to Walmart ratio. So if we just look within the retail sector, what's driving the retail weakness? It's not Walmart. Walmart's been doing great lately, but I like to look at this gap to Walmart ratio because it goes back to the 80s. You can look back through several cycles, and you can see when gap is dramatically weak relative to Walmart, that's usually coincides with bear market and recession. You can see, this ratio peaked in mid 99 and sold off pretty hard It was kind of a decent leading indicator for this topping process for the market in 2000. Same thing in 2008-9, but it's been really more marked, over the last year or so, where you see Gap dramatic underperformance relative to Walmart. And to me, this is another one that just makes intuitive sense, where you have, when people are earning good money and the economy is good, they're more likely to go spend money at Gap. When things are not so good, they're more likely to, spend on staples and things, or be kind of more cost conscious and spend money at Walmart. Another similar ratio that I've looked at for a long time is this Dollar Tree to Macy's ratio. We could make it Macy's to Dollar Tree, so it would look similar to this one, but I prefer to look at it, almost as like, this reminds me of this chart of the New York Fed's recession probability model. When this thing spikes, that means the probability of recession is getting higher. When people, and it's very similar to this other ratio. When things are good and people are feeling, more willing to spend, they'll probably spend on more higher ticket items at a place like Macy's. When money's tight, they're more likely to focus on something like Dollar Tree. And right now, this ratio is spiking. It did spike, in that 2016 and even into 17. And some of this trend is obviously just the retail apocalypse, right? A lot of these kind of mall-based stocks have generally been doing very poorly. But I think that explains the trend. The spikes themselves, that doesn't necessarily explain the spikes so much. And so the spikes, to me, can be a warning of economic weakness. And so it's these kinds of stocks, the retail names and most specifically the most economically sensitive retail names that are driving the divergences underneath the surface of the indexes. And we can see these divergences when we look at things like, this is the S&P 500, the ratio of the equal weight SPY to the market cap weighted SPY. And you can see when this is driving higher, that to me says that there's really good broad buying, broad strength among all 500 stocks, and actually the smaller ones are leading. When you have this decline, it means that it's a fewer number of stocks within the index that are driving the index higher, and there are more and more stocks that are kind of falling off. So you're getting this increasing dispersion under the surface, and we can see that in another ratio, this Russell 2000 to the Russell 1000 ratio. We can see this peaked June of last year and rolled over, which is a pretty decent warning signal that these, the push to new highs in the S&P 500 early last fall, was, maybe not sustainable with the Russell 2000, the weakness in the Russell 2000. But we've also seen that, since early this year, February, March, I think it was March when the Russell 2000 really started rolling over versus the Russell 1000, big cap stuff. And, this, goes back to a couple of things. It shows the increasing dispersion in the market, but it's also, as I mentioned, Stan Druckenmiller looks at this as almost an economic indicator as well. And so the weakness in the small cap names is, another red flag for this market. One other indicator that I like to look at in terms of breadth dispersion is the Hindenburg-Omen, and I think the Hindenburg-Omen's gotten a bad rap. Recently, people have kind of made fun of it as a false signal or worthless signal. I don't really put much stock into one signal, but when you get clusters of signals, it can mean something. And it usually does mean something important. And Hindenburg's only triggered when you have stocks at new highs or very close to new highs, and you have a growing number of both new highs within the index and new lows within the index. And so you have a bunch of new lows triggering at a time when a market's at a new high. So that is by definition the definition of dispersion under the surface. And so this chart here shows when you get this indicator at the top of the page here up to 3, that is a triggering of a Hindenburg Omen, and you can see this is the New York Stock Exchange. Since mid-July, we had 7 Hindenburg's Omens triggered in less than a month's time. And if you just look back over time, we click on this chart, and let's just go back 25, 20 years, probably enough. And you can see when you have clusters here, you can see we had a couple of little clusters here at the 2000 top. That was in, March, late 99, and then fall of 2000, we had some clusters. At the 2007 top, we had some back in 2006, and then 2007, we had two big clusters in the summer and fall of 2007. We had some clusters here in 2015, right before we had that the August 15 sell-off with the won depreciation, and then the early 2016 sell-off. We've had tons of clusters really since, leading into the 2018 peak here. Another way to view this is I like to run the number of Hindenburg omens triggered over the last 12 months. And so this chart, this is on my website. You can see at the 2000 top, we had just over 20 Hindenburg omens triggered into the fall of 2000. We had 37 or so, I think, at the 2007 peak. Last fall, we had over 50 Hindenburg omens triggered over the last 12 months. We're now back to 42 Hindenburg omens or something triggered over the last 12 months. And so to me, this is a very clear signal that we're having a lot of dispersion under the surface. So index is at new highs, but it's not being driven by a breadth of stocks within the market. So that's the way I view breadth, and all these things are kind of saying the same message to me, which is we're seeing more and more stocks drop off out of the bull market that are falling into bear market type of territory. Another thing I like to look at is momentum, and I think the Copic guide or Copic curve can be very helpful here. It's a very simple indicator, was developed more as a buy signal, that when the indicator moves above zero, it's a sign that momentum is strong and it's safe to long-term signal to buy. We can see here that momentum has been waning through this, like I call it a topping process, and we're very close to the zero line. A drop below zero would be a sell signal here. You can see the last few sell signals here in early 2001 and in early 2008 were decent, signs that a bear market was underway. This was kind of proved to be a false signal from 2015-16. But another way that I look at momentum too is to come back to here. This function that StockCharts has, this is very, very handy. The past data function. I'll download the data into a spreadsheet, and then Michael Oliver is a friend of mine who's developed this momentum framework, and you can basically look at price relative to a moving average. And so this chart shows the whole bull market, and it shows the price of the S&P 500 relative to its 36-month moving average. So this would be demonstrating very long-term momentum. You can see momentum got really, really strong here in late 2010, early 2009. Very healthy sign that this was similar to a Copic guide buy signal, that this is a very strong push higher and was going to continue on. You took out, made a new high in momentum, and here in 2013-14, started to wane prior to this decline here, but we've made a lower high in momentum in early 2018, another lower high in late 2018, and then these new highs that we've made here this year are come on much lower highs in momentum. And so to me, this is the best visual representation of how strong is this market right now. Well, in the context of this long-term bull market, these new highs are coming on some of the weakest momentum we've seen during the entire bull market. And as my friend Michael Oliver, like I said, he's developed this momentum framework, says if you just draw a horizontal line here on the lows in momentum, this is a huge momentum structure that's lasted about, almost 10 years now. And breaking below this, whatever it is, 4 or 5% where the support is, would represent a massive shift in this trend from bull trend to bear trend. And so that's something I'm paying close attention to. This waning momentum confirms the idea that this is a topping process, but the real bear market confirmation would come from a breakdown to a new low in momentum. Not necessarily a new low in price, but a new low in momentum. Another momentum signal that I like to look at, and if we have time, I can actually explain how this works. Every time I run these Demark Sequential indicators on a chart, people say, hey, where is that in StockCharts? And so It's not on StockCharts. You can't get it on any charting platform except for, I think, Bloomberg, and you have to pay $1,000 a month extra or something for the indicators. But Tom Demark is a gentleman that I met a little over 10 years ago, introduced me to these exhaustion indicators that he developed. Tom is a brilliant guy who's worked for essentially whoever's run the biggest hedge fund on the planet. Tom has had Tom on staff for the past 30 years. So, but Demark Sequential is something that I look at because it's an exhaustion indicator. And it's basically got two phases. There's a setup and then a countdown. In the setup, you essentially just need 9 closes in a row where the closing price is higher than the close 4 bars before it. So you can see here's the 1. I only labeled the 9 because here's the 1. This close is higher than 1, 2, 3, 4. So you have 1, 2, 3, 4, 5, 6, 7, 8, 9. Trust me, these are all higher than the close 4 bars prior. So then you get the 9, and that completes the setup. Sell setup's complete. Once you get that, then you're looking for the 13, which would be basically you need a close that is higher than the high from 2 bars prior. So here would be the 1, because this close here is higher than that. So 1, 2, 3, 4. This one doesn't count. So these have to be sequential. If you have 1 bar that doesn't meet the criteria, then you don't have a sell setup. You have to have 9 in a row. These do not have to be sequential, so they don't have to be 9 in a row. We can have 1, 2, 3, 4, and then we have 5, 6, 7, 8, 9, 10, 11, 12, 13. So we had a daily Demark sequential sell signal back here in mid-July. When you look at the weekly chart, we had a weekly sell signal also in mid-July. I look at the monthly chart, we had a monthly sell signal back here in late 2017. And on this time frame, this was a pretty decent sell signal. Stocks have really gone nowhere since that sell signal. And we can even look at the quarterly time frame too, which is, I love that, StockCharts is one of the only platforms that allows me to run quarterly charts. And this is actually SPY, not the S&P 500 index. But when you have a very strong uptrend, Tom has said that sometimes you'll get a 9-13-9 sell signal. So you'll get a setup, a countdown, and then another setup afterwards. And that's essentially what we've had. If you go back to the very beginning of the bull market here in 2009, we had a sell setup complete in late 2011. We had the quarterly Demark sequential sell signal in early 2015. And that's when we had that late August 2015 sell-off, early 2016 sell-off. So that was a pretty decent indicator too. But on this time frame, you're really looking for a multi-quarter reversal. And then we had, after this, we had another sell setup complete. So you had a 9-13-9, which Thomas said is the most powerful sell signal that you can get. And since that time, stocks have gone nowhere. So to me, this is kind of also an exhaustion signal that's confirming the signal for momentum. And so aside from momentum, something else I like to look at, risk appetite. Risk appetite to me is maybe one of the most important things to pay attention to when investors are risk seeking. Stocks should do well. Junk bonds should do well. When investors are not risk seeking, they're more risk averse. And I'm not talking about like risk on, risk off. I'm talking about looking under the surface and seeing what types of stocks investors are embracing, what types of securities. And so we can see these ETFs only date back, to the mid 2000s, and so we can't look back at the 2000 top. But if you do look at this top panel here, this second panel from the top is essentially a replacement for spreads, for corporate bond spreads. And so we have higher prices here on the top. This is the S&P 500. Then this is the corporate bond ETF relative to the same duration Treasury bond ETF. And so when spreads are narrowing, and it's also, when spreads are narrowing, that's a sign of risk taking. Spreads are widening, that's risk aversion. And so when you have stock prices moving higher, but spreads widening, or investors preferring treasuries over corporates, that's a sign that investors aren't embracing risk the way they should. And so we saw this at the 2007 top. We saw this leading into that 15-16 sell-off, and we've seen it more recently over the last couple of years too. Even more, it's been more pronounced in junk bonds than in general corporate bonds, but we still see it here in corporate bonds as well. This is basically just a very simple, in this panel here, this is the SPY to the consumer staples ETF ratio. Investors should be embracing risk by buying SPY over staples, but this is basically just a shorthand version of another risk appetite type of indicator that I use. And so when investors are piling into consumer staples rather than into tech or consumer discretionary or what have you, it's a sign that they're risk averse. And so we could see divergences here where staples are outperforming. Staples have been outperforming dramatically since early mid 2018, which tells me that investors aren't embracing risk in the equity market the way that they should be. And then finally, this is also a risk appetite thing here too. This is basically just the VIX inverted with the S&P 500. So the VIX, when stocks are making new highs, the VIX should be making new lows, right? It should not cost as much to buy protection against the S&P 500 when it's moving higher. People should be less inclined to buy protection, and so the VIX should be making new lows. But you can see at the 2007 top, prices were making new highs. VIX was not. VIX was actually making higher lows. And like I said, this is an inverted chart. So this tells me that investors were keenly buying put option protection more so than they should be when prices are making new highs. Same thing in 15, 16, and same thing recently. The VIX made its most recent low in late 17, hasn't made a new low since, even though price made a new high in 18, again in summer of 18, and this year, VIX has been making higher lows. This tells me that there's a lot of put buying going on. That's a lot of risk aversion. That's just not healthy for the broad market.
Hey, Jesse.
Yeah.
Question that kind of general question, I guess. Obviously you're looking at the market and appear to be, pretty bearish based on all the support and arguments that you've provided here. How are you trading the market? I mean, are you looking just only on the long side at defensive areas of the market? Are you shorting? How are you trading the market right now?
Yeah, thank you for the lead in. That was exactly what I was getting to right now, Tom. I'm almost always long short. And so I'm long certain things that I think are attractive. I'm shorting things that I think, and generally right now, a lot of my shorting is focused on the broad indexes. So I'll short SPY, QQQ, IWM against my longs just as a hedge. And so, but I think generally for most people, reducing your exposure to equities during a time like this makes perfect sense to whatever extent you're able to. And for some people, if you have equity exposure, you don't want to take capital gains or whatnot. You can go to my site. I wrote this post right here. Worried about a stock market crash? Here's how you can tail hedge your portfolio. It's a very simple tail hedging strategy developed by Mark Spitznagel that he wrote about in his book, the Tao of Capital. And so it's a very simple put buying strategy. But what I'm doing more specifically is I think investors should focus on value. This is essentially the ratio of value to growth. And to me, this looks very, one of my favorite chart patterns is this kind of ending diagonal or bullish wedge pattern. And to me, it looks like value is forming a bullish wedge right now, longer term. And I'm watching this chart weekly to see when this thing's going to break above this downtrend line here, because once it does, I think there's going to be a very interesting and then this also really reminds me of 2000. If you look back, if you go back to 2000, in the let's see, how do I go? There were, really it was the NASDAQ and the .com stocks that were driving the market, but there were a number of stocks that were absolutely left for dead, value stocks back then. It's not as dramatic today. I think the market is more broadly overvalued today than it was back then. But there were stocks like Ball Corp. This was a stock that I bought back in 2000. I sold it way too soon. But Bill Stieritz was the CEO. It was the CEO of Ralston Purina before this. He came in, he put in his whole management team, and he bought something like $40-50 million worth of stock with his own money. And all of his top executives essentially put close to their 100% of their net worth into the stock with open market purchases. And the stock's up from $2 to $80. It's up 40-fold. since then. So there's opportunities like this in value names. I think today in the market today, and this long term, and we could go back even further with this thing, and you can see value's been dramatically underperforming for this entire bull market. It's actually one of the worst drawdowns for value in history, and so I think there's a terrific opportunity today to focus on value. One of my favorite ways to do that too is rather than use a market cap weighted index, there are the fundamental indexes that are created by research affiliates. I think Schwab has a couple of ETFs where they're not weighted by market cap, they're weighted by sales, they're weighted by book value, they're weighted by these types of things. And it's basically a way to just limit your exposure to overvalued stocks today and put a little value tilt on your portfolio if you're using ETFs.
Hey, Jess, I'm sorry, but yeah. there was one, we're gonna have to wrap up here in just a minute, but there was one specific question that had come in about gold. And whether or not you have a favorite gold stock or how you would play the gold market. I mean, in 30 seconds or so, do you have an answer for what to do with gold?
Yeah, this is my final chart here. The Copic guide shows a buy signal in gold. And if you even look at the gold to SPX ratio, usually it's a good, you want to own gold or stocks because they usually don't do well at the same time. We recently just got a buy signal here too, in the gold to SPX ratio. So I like gold. I like it used to be the Central Fund of Canada. It's now the Sprott Physical Gold and Silver Trust. Its thing still trades at a discount to its gold and silver. In the short term, I think gold could pull back. I think it's definitely overbought and overloved right now. Sentiment's really high, but I do think gold makes a lot of sense for people to own over the next, I don't know, 5-10 years.
All right. If somebody wants to follow you, where should they go? Felderreport.com?
Felderreport.com, and I'm on Twitter at Jesse Felder. I usually share a bunch of stuff there.
Okay, that's awesome. Well, it's always a great, a great pleasure having you on the show. You gave everybody a lot of food for thought from a bearish perspective, and it's always good to look at markets from, different angles. So we certainly appreciate you taking the time out and joining us here on Market Watchers Live.
Thanks for having me on, guys. I'm a big fan of what you guys do, and I appreciate the opportunity.
All right. Appreciate it. Thanks so much.
Excellent.
All right, Erin, are you ready? I didn't know if you had an RRG or.
I do indeed.
Okay.
All right, here we go. So this is a daily one. I've started to switch it to the daily since we're looking at 10 and 10 in a very short-term way. So looking at the daily RRG, you can see a lot of these moving into that improving category. So I thought there were some pretty good picks this time around. So you'll probably see a few of those.
All right.
First one is plan, a simple plan.
All right. I like plan. I think that the volume, it's been down quite a bit here the last couple of days with earnings, but a lot of positives were built into this stock on the way up. I mean, the stock ran from $37 to $60 in just 2 months and has been consolidating. I think the action the last 2 days takes us back down to a key area of support. I think if you see a close below 52.5, I would take note of that and be a little careful. But it has been one of the better performers. Doesn't mean, we've seen some relative weakness here just recently with its earnings report, but it's still in an overall uptrend. I think if that continues to the downside and we can't hold on to support, then I would be getting a little bit more nervous. Right now, I'm okay with it.
All right. We had two most populars in the chat room. So let's start with Match Group, MTCH.
Yeah, Match had a really awesome earnings report, and I think it continues to trade pretty well here. I'm fine with it. I think if you look at it from a price perspective, price support perspective, I think right around that 78, 79 area, I'd be watching after we gapped up with the heavy volume. We went down, tested that, put in a nice doji right at price support, right on the 20-day moving average. I think we're just sitting maybe between those two areas. So price support around 78, resistance around 95. I like the stock as it moves down, maybe toward the low 80s.
All right, excellent. The other most popular was INT.
Right, INT.
Fuel service and transportation services industry.
All right. Yeah, the group hasn't been very good, but this has been a strong stock within the group. So the way I trade this, when I see excellent relative strength, and even though it's been in a bad group, it continues to outperform the S&P 500. That's one of the criteria I find to be very important. So it's outperforming its peers. It's outperforming the S&P 500, but you have to recognize that it really is in a group that just hasn't been doing much. So what does that mean? It means I'm going to keep my stop in play because I do not want to get taken out to the downside and continue to hold a stock that's in a poor group. I don't like that false breakout, that candle. That was just a short-term warning sign. I think things would turn much more negative if we fail to hold about the $35.50 to $36 level.
All right. Let's see. The next one up is Sunrun. Run.
All right. That is in the renewable energy space. I think from a relative perspective, yeah, it continues to drop. I think there are just better stocks in this space. I mean, you can see here the relative weakness continues versus its peers. I mean, this has been the best performing group in the market, no exceptions in 2019. And you can see, especially recently, it's accelerated in terms of relative weakness. The volume has been poor on the breakdown. I don't like it. I think if you were looking in this area, I'd be looking at either SEDG or maybe Enphase Energy, ENPH. Next key support level on run's going to be down around 14, but I think it's already showing a lot of warning signs. I'd be switching or I'd be out of it.
All right. Let's see. The next one up is going to be SNPS, Synopsys.
All right. Synopsys in the software space. I do like that big volume there, but it failed to get that breakout, but it's in a flag. So a nice uptrend, just kind of sideways consolidating. A breakout, I think, would be very bullish. And the relative strength, all those relative strength charts, I think, looks pretty good here. So let me pull up the resistance line. So right about there. I mean, we tried to get through, couldn't. And now we're just consolidating above. Maybe watch gap support to the bottom right here at about 131, 132. I think the stock breaks out in time. I mean, it's good, solid relative performer versus software right now.
All right. Next one up is IIPR. It is the only real estate request.
All right. Taking a look at real estate, IIPR. Yeah, I mean, the relative weakness there bothers me. I think we're just kind of consolidating, maybe in a little bit of a flag off of the downtrend. I would be careful if we lose these recent lows. I mean, we've now tested this 99, 98, 99 area multiple times after breaking out. So here, I think what you can see is sideways consolidation, a breakout. You set a new high around 99. You come down, you test it, to test that prior breakout, and then you go up and you break out again. And notice we didn't go back and retest it until these 4 times. I think if you break down below 98, 99, I'd have a tight stop in there. I'd be a little careful, especially given the relative weakness that's taken place here over the last 2 to 3 months. So I'd watch that key support level very closely.
All right. How about FOSL Group, FOSL? And I feel like that came up in a scan for me today somewhere.
Yeah, this one probably did the momentum because I saw it earlier too, making a pretty nice break. I think it's got a little bit more work to do. This could just be a short-term bounce, but if you're in it or thinking about getting in it, I would be looking at a couple of things. Number one, the breakdown that occurred back in May below this area had not been tested until yesterday. We literally went right up there, failed, and we're holding up so far. Volume has been better, so that's a good thing. I would continue to watch the rising 20-day. Do not lose sight of the group that you're in, which is clothing and accessories, which has been horrible relative to the S&P 500. So if this stock is starting to show strength and can't hold it, I'd be back out.
All right. This one, this request, I actually have my finger on the trigger. I'm just waiting for it. I might just get in it here soon. Kratos, KTOS.
Yeah, this was one of my favorite defense stocks, but I'll tell you, the earnings report, it did turn where I would have expected it to turn, which is right at $18, and I'll show you that price support. Once it failed, well, there's that prior breakout that was never tested. And notice where we came down, we put in a nice bullish engulfing candle right at that 18 level, bounced. But I think we're at a major test here. I love the group. I love the defense stocks. But this stock is in a bear flag, definitely short-term flagpole, coming back up, testing that overhead resistance at the 20-day. The one positive I see is this is not a light volume test of the 20. This is pretty good volume coming up. And as I mentioned, This is a very solid group relative to the S&P 500. So if it can break back up above that 20-day moving average, I give it a pretty good chance to continue rallying.
Yep, that's like I said, it is. That's really important overhead resistance. If it pops above that, I probably will pull the trigger on that one. All right, let's see. The next one up is SGMO, and that is Sangamo Therapeutics.
Yeah, this is one just been hovering. I mean, and you look at the relative charts, they're not exciting. There's really nothing on this chart that's doing much for me. You get these gaps and then failures. There was one back in April. Right here. Here's another one that just happened in July. Big volume, huge gap up, and then nothing. No follow through. Sideways action. Granted, it's in the biotech area, but biotech's weak. So I don't see anything exciting here. I'd pass.
All right. Sort of an interesting one. Vibha Systems. I think the person said, "What's going on here?"
Yeah, this was earnings related. Stock just came out with earnings. Huge gap up. Talked about this one a little bit earlier. I really like the stock. I think that this is one that will continue to do well. Yeah, it's volatile, but it's always volatile after earnings. I mean, there's your breakout. Here was your big move on earnings volume back in May. Sideways consolidation. We broke out above that 155 level. We held it here. We held it here. We held it 2 more times in here. And today we went right back down, tested it again, and buyers were there again. Stock down $1.88 today, but I think the stock's just consolidating sideways, which is fine after this huge run up. Let it consolidate, build a base. A breakout above 176 would be bullish.
All righty. That does it for the 10 and 10. Those are 10 stocks, and they were annotated in less than 10 minutes, I believe. So great job. And it is time for our poll. We got to wrap up this show at this point.
Yeah, I mean, which of those groups do you think? I mean, when looking at, and these were the 5 best performing industry groups since the S&P 500 topped a little over a month ago. Which one of these do you believe would you be most comfortable holding next month? I'm going to guess gold for you. What do you think? What is it?
No, it isn't gold, believe it or not. Although I think gold's still got a lot in it. The one I have to say, I actually bought one in the specialty REITs today. So I got CoreSite Realty. I'm not giving anybody any financial advice here. I'm just telling you what I did. So anyway, yeah. So I ended up with specialty REITs myself. So.
All right. Well, I like a group that's been the leader in 2019, and it's been consolidating, but I think that's healthy. It's actually continued, even in a bad market, it's been showing nice strength, and that's the renewable energy. So it's hard for me not to like that. I like home construction as well. Short term, I like gold mining. I'm just a little concerned holding it a month.
Yeah, and miners are a little different than actual gold. They're a little bit more subject to the winds of change in the stock market itself. So if I were going to do gold, I would do the actual, I would do GLD. Yeah,
I would agree with that. I wish I'd had a little bit more time with Jesse, because I did want to ask him one thing about employment and the fact that employment continues rising and, near record unemployment lows. And so that to me maybe is a little bit bullish from an economic perspective. Usually before we turn down, we see a pretty big drop in employment, or at least in the rate of change in employment, but we haven't really seen that yet. So
no,
that will be something to keep in mind. Anyway, you can see on your screen there, you could see on your screen, Dow Jones currently up over 200 points as we bring this to a close today. Want to thank everybody for joining us. Certainly a shout out to Jesse Felder for joining us here on Market Watchers Live again. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1 p.m. Have a great Wednesday afternoon, everybody, and we'll see you back here tomorrow. Happy trading.